Hello, my name is Derek Hashi, and I would like to welcome you to our RESPs Understood 5-part series. This is our part 4 video focusing on explaining how money can be withdrawn from the RESPs for your child when attending post-secondary education. Now that you have talked about getting money into your RESPs, in this video, we'll talk about getting that money out. You'll want to stick around because we're not just going to educate you on how taxes work with RESPs, but it'll educate you on how you can avoid paying any taxes. Before we get started, I'd like to introduce you to our team. My name is Derek Hashi, my partner is Nathaniel Asifa, and we have over 7 years of combined experience as financial advisors. We help Alberta professionals and their spouses attain their desired retirement income, and we're able to apply legal methods to engineer taxes out of our clients' retirement. We don't get stuck on labels, but are driven to take an objective approach to evaluate the suitability of all financial vehicles and options for each of our clients and recommend the right fit. In addition, we also work to ensure that our clients have the right protections in place. Before we get into withdrawing RESP from the RESP account, let's look at what the main components of an RESP are. Starting from the bottom, we have the principal. Now, if you recall, this is after-tax money you invested. And since it was after-tax money that you put in, this money can be withdrawn without taxes being applied. Moving up the chart, we have the grants. And of course, this is the money you receive from the CSG or the CLB and taxable as income at the marginal tax rate when withdrawn by the student in post-secondary education. If grant money is not used by a beneficiary, then it must be paid back to the government. And lastly, we have the income portion or the income component. This is the investment growth from both the principal and the grants, and whether it's interest, dividends, or capital gains, it is taxable as income at the marginal tax rate when withdrawn by the student in post-secondary education. If the income is not used by the beneficiary, then it will be taxed at the marginal tax rate of the subscriber plus a 20% penalty. There's more on the specific topic that we'll cover in the Part 5 video, so stay tuned. When income or grant money from the RESP is withdrawn for your child while attending post-secondary education, it is called an Education Assistance Payment, or EAP for short. The EAP is taxed at your child's marginal tax rate. After the grants, the next best advantage of having an RESP for your child is to be able to have your investment growth be withdrawn for your child in post-secondary, and rather than it being taxable to you at your marginal tax rate, it is taxable to your child at their marginal tax rate while they're at their lowest income years. Due to applicable federal and provincial tax credits, your child may not even have to pay taxes on those incomes and grants. Even if they have to pay income tax due to their EAPs, it's likely to be a very small amount. In order to make an EAP, you must have proof of admission letter from the education institute where your child is studying. And the EAP can be used for any purpose, whether tuition, rent, or any other expenses. No receipts need to be submitted to the government to justify or verify what the EAP was used for. Now let's cover a few basics. In Canada and Alberta, we have a progressive tax system, which means that the more you make, the higher average tax rate you will pay. Practically speaking, this means that we have tax brackets. We will be using the 2019 CRA and Alberta income tax rates, credits, and brackets in this video. Today, we'll look at how you are taxed if you're in less than $30,000 income, which means that we'll only look at the bottom tax bracket federally and provincially. This is very typical for post-secondary education students that are drawing from their RESPs. From an income tax perspective, your income is taxed at 15% on the federal side for your first $47,630 earned. If you made more than $47,630, your income would be taxed at a higher percentage on the amount that's over the 47 grand. Your income is also taxed at 10% on the provincial side for the first $131,000 you make. income made above $131,000 is taxed at a higher percentage. So let's assume that your student has a part-time income of $4,000 and received an EAP for $20,000, giving a total income of $24,000. He or she would owe $24,000 times 15%, meaning that it would be owing $3,600 in federal taxes, and would owe $24,000 times 10%, meaning $2,400 in provincial taxes. Now, let's look at the tax credits. Tax credits are calculated from certain amounts of money that are mostly applied to your basic federal income tax bracket rate and your provincial income tax bracket, basic income tax bracket rate. Let's look at the applicable federal tax credits for this post-secondary education student who has a part-time job. The federal basic personal amount of $12,069. This is given universally to everyone. We have the Canadian employment amount of $1,222. This is simply calculated by taking the smallest number between this number and your gross salary. And this number being smaller than $4,000, this will be the amount of the Canadian employment amount. We have also the CPP and EI premiums. They also count as a tax credit. And here it's adding up to just $90.30. We have the tuition amount. Here we're going to assume a $5,000 tuition was paid, and that's also a federal tax credit. So meaning that our total federal tax credit adds up to $18,381. And if we multiply that by 15%, we get $2757.20. On the provincial side, we have the provincial personal amount, and this is $19,369. Again, this is given universally to every Albertan who earns an income. And we have the CPP and EI premiums, which is also $90.30. And the tuition amount, again, that's also a tax credit in Alberta, and that's $5,000. And we have a total provincial tax credit of $24,459.30. Multiply that by 10%, and we arrive to $2,445.93 coming back in taxes at the end of the day. The federal, this number here and this number here is what's going to be reimbursed at tax time to the taxpayer or to the income earner. So if we look at the net taxes that are involved here, on the federal side, well, we owed $3,600 of income tax on the federal side. If we deduct the tax credit, the $27.57, the tax credit, we arrive at a difference of $842. So $842 owing on the federal taxes. On the provincial side, well, our tax credits exceed the amount of taxes owed, meaning that we will not have to pay, your student would not have to pay any provincial income tax. So one thing that to note here is that at the end of the day, you don't effectively pay any income tax if the total income falls below the federal and provincial tax credits. And this becomes an important rule of thumb that we'll talk about here. Whenever we're thinking about withdrawing from RESPs, we're mediating between these competing objectives. Number one, well, we want to avoid the loss of the grant money. As we said earlier, if the grant money is not used by the beneficiary, or by any beneficiary, then it must be returned back to the government. We also want to minimize or eliminate taxes and perhaps penalties paid by the subscriber, who if it would be paying taxes, would be paying at a much higher rate than the beneficiary. And third, we want to minimize or eliminate the taxes paid by the beneficiary, of course. And it'd be great if we can achieve all three of these objectives. And I think that's what we're going to strive to do here. The beneficiary should try to use the grant money first as their EAP, because if it's not used, it's forfeited back to the government. So that's an important rule of thumb here, is that we try to use all that grant money first. The next priority should be for the beneficiary to use the income money as the EAP, because if it's not used by the beneficiary, then it'll be taxed at a higher rate and it'll be a higher burden on the subscriber. And lastly, the beneficiary should, if possible, avoid an EAP that, combined with any of their part-time income, would exceed their federal and provincial tax credit amounts. So that's our approach for going forward. So let's look at an example here. Let's assume the beneficiary would have made $4,000 on a part-time job and paid $5,000 in tuition. Well, the federal tax credits would be as followed from the 2019 CRA numbers. The federal tax credit, which is the purple bar here, would be composed of the Canadian employment amount, the federal basic personal amount, the tuition that was paid, the EI and CPP premiums, and that would total up to just over $18,000. If the beneficiary needs more money than this, then he can withdraw some of the principal tax-free to make up the difference. If we recall, the principal that's invested in the RESP is invested after tax. Therefore, when it's withdrawn tax-free, whether it's the subscriber or the beneficiary that's withdrawing. As long as the beneficiary is expected to be in school for a sufficient amount of years, use up the RESP grants and income as EAP payments, then nor the beneficiary or the subscriber would pay a single cent in taxes for withdrawing from the RESP. If there's principal left over after the beneficiary is finished school, the principal remainder can be withdrawn by either subscriber or beneficiary tax-free. So here, just to take another look here, is that we have the federal tax credits, which is about 18,000. In Alberta, we have more provincial tax credits. So as a rule of thumb in Alberta, if we keep the part-time income and the EAPs below the federal tax credit line, then effectively no taxes are paid. If you need more money than that, then start taking out from the principal that was invested and no taxes are paid there. So that's an example of how you can get away from with amassing a lot of money into the RESPs for your child or children and planning it out effectively such that when it's withdrawn, when it's used, there are no tax consequences as a result. Now let's consider a more complex and extreme example, because sometimes it won't always work out, but we'll show you how to minimize things in this example. Let's assume there's an individual RESP owned by a subscriber for a beneficiary with a balance of $76,200. The principal portion of that is $40,000, and the grant total is $7,200. The income portion is $29,000. That's the amount that's grown into the RESP from the investment and the grants. The beneficiary will be studying for about 4 years and paying $5,000 tuition each year. The beneficiary is earning an $8,000 per year part-time job as a lifeguard. And the beneficiary needs about $20,000 per year for their post-secondary education needs. Now, as a result, there would be a federal tax credit of $18,000, $650, and a provincial tax credit of $24,000, $728, as we see here in this illustration. So here's our tax credits on the federal side and our tax credits on the provincial side. Now, again, we try to, let's use the fact to keep under the federal tax credits first, because that's the lower one. And if we keep under the federal tax credits, now we'll be home free in terms of net taxes owing. So here's how we can set this up annually, assuming the RESP is earning 6% rate of return. The $8,000 of part-time income, well, that's a given, and that's the first thing that comes in, that plugs in, and it's tax-free because it's underneath the federal tax credit amount. So this is effectively tax-free. Since there's too much RESP and grants to keep below the federal tax credit amount over the post-secondary study period, in this particular case, we're just imagining that we have a bigger RESP, we'll need to exceed that a little bit with having an EAP withdrawal at $12,814. So if we look at the grant room at $7,200 and the income portion at $29,000, and it's also keeps growing at 6% throughout the university career, in order to time this out, we're going to need to withdraw $12,000, $12,814 from every year in the EAP. So the first $10,650 of the EAP will effectively be tax-free due to being within the federal and provincial tax credit limits. So if we look at that first $10,000 of the EAP would land you about here. And now we'll have a little bit more EAP. We have another 2,164 to go of EAP here. We have this portion of EAP happening here. Now, here, this is an interesting situation because this additional amount of EAP is exceeding the federal tax credits, but it's not exceeding the provincial tax credits. Therefore, there will be no provincial taxes paid as a result on that portion of the EAP. However, since we've ran out of federal tax credits, the federal tax credit, the federal taxes will be effectively applied on that amount. Now, if you look at $2164 taxed at 15%, that's about $325 in taxes in total. And then the last part where that we can get away with, we'll just withdraw the last $7,500 from the principal, and that's going to be tax free. So this is, here's a situation where basically we're registering an income of just over $20,000, and net, at the end of the day, net, we're only paying $325 in taxes. And if you look over 4 years, that's going to result in about $1,300 in taxes paid. And not only that, but also $9,744 is returned to the subscriber or parent or beneficiary or whoever in those between the two, tax free. So here's that's a good example here with effective planning, how we can configure the EAPs in such a way that they will minimize and in many cases actually eliminate any taxes that are paid. Now, here's some final thoughts on using RESPs. At the end of the day, here's kind of the basic steps that we have to follow. Number one, estimate the beneficiary's tax credit for the year. And this is simple enough. You can look at the numbers I've presented here. They're posted on the CRA website. And if you're not familiar with them, either your financial advisor or your tax planner can probably figure them out for you. Make sure that enough RESP income and grant money is planned to be withdrawn throughout all the years of study. So whether they're studying for 4 years or 8 years, keep a close eye to make sure that you will withdraw from the grant money first and then the RESP income money next, such that that all gets used by the beneficiary or by your child throughout their post-secondary career. And then try to keep the EAPs and other beneficiary incomes below the tax credit amounts. And in here we looked at pretty trivial examples of part-time income, lifeguard or some other form of part-time income. Some students will also go through a co-op program or a PEP internship. So those would have to be planned out a little bit more carefully in those cases. And if you cannot keep the EAP within the tax credits, it's usually better for the beneficiary to pay those taxes anyway, rather than the subscriber. So now all this is well and good, but what happens if your child doesn't finish school or simply just doesn't use up all the RSPs and doesn't go to school at all? There are some important consequences to this, and we'll go over that and the solutions to those consequences in the next and final video in this series. And with that, I'd like to thank you for watching this video. I hope that this short video was value added for you. If you have questions or would like to book a free consultation, you can contact me via email or schedule a strategy session by clicking on the link or button below.